All right, guys, welcome back to episode 25 of the Slap the Ask show. Today we have an amazing guest, one of our good friends on Twitter. Kind of been following him for a while. His name is Doug. You can follow him at DJ6IL. Doug is an MBA, CFA, CP, CU. Has all those credentials. He's in investments and geopolitics out of Texas. Doug knows everything, so this is going to be a really great show. Doug, thanks so much for coming on.
No, it's a pleasure.
Yeah, thanks for coming on, Doug. I'm excited to have someone from the institutional side of things come on the show and talk to us about the market and investing. I feel like on Twitter, you always hear about people talk about retail and how, the stock institutions are coming in, so it'd be kind of nice to hear from the institutional side.
Yeah, we come in a little bit after the people that you have had on the show. The OTC people kind of come in first, and we kind of come in a bit later when things are a little more established. So getting a little more of the spectrum in your guests.
Yeah, that's good to be diverse. So I guess the first question we can start off with is you have all these credentials. So like, what's your educational background? How did you come to get these certifications and why did you get them? And kind of how did you originally get into investing to begin with? Was it from a young age or later on, or what was that journey like for you?
In investing, I was interested at a young age because my father invested. He was in the tech industry. He's a computer programmer, and he invested a lot in tech stocks. And I think we're gonna have I'm in the office right now. I think we're gonna hear the vacuum for just a minute, but. Anyways, so he was in tech stocks, and so he would buy us for every Christmas, buy us a share of IBM or something like that, and he wouldn't sell it till he went to college.
Wow.
That was part of how he paid for school, and it was just interesting to me. I read books on it, and I don't know why I didn't do it when I went to college per se, because my dad he was laid off from work, and so he started his own consulting firm. To help him out a bit, I learned how to program computers and did computer science in undergraduate in Miami, Ohio. Oh, nice. I was there while Serbiak was there, when Ben Roethlisberger was there.
Oh, wow. So the football team was pretty good those years, I guess.
They were great. Yeah, they made bowl games and stuff and won MAC championships. Not that I knew either of those guys, but I knew they were there.
Hey, still pretty cool.
Yeah. They had a few other NFL players as well, people that aren't in the league anymore, but it's amazing that guy's still there.
Yeah, it's crazy.
Kind of early.
Break.
It's insane, yeah. And I think MACtion starts today, the Wednesday games that the MAC does. I think it's great because everyone loves betting on them because there's not really much else to bet on a Wednesday in the fall. So it keeps everyone engaged.
Yeah, nothing better taking a MAC game on a Wednesday.
So Doug, pivoting off of your credentials, I noticed you have a CFA, which this past year, I saw a lot of reports how the pass rate for the CFA exam has been at all-time lows. Can you explain a little bit about the process behind studying for the CFA and just what it entails and how much effort it takes to get a passing grade for an exam like that?
Yeah, I think it's just the reason it's hard for people is it just takes a lot of time, and when you're an adult and you have family and you have work, it's hard to find that time. Like I did it before I had kids and before I had a wife, and I don't think it'd be very easy if I did it today. But I was like you guys, I was single and had the time then. It takes they say 500 hours for all three of them. It definitely is more than that. It was more of that for me. And the hard part is you just don't know what's coming down the pike on the first test. It's kind of like you have to prepare for everything because you have no idea what they're going to throw at you. Mm-hmm. And so it's very scary because at that time, I don't know if they're still this way, but at that time, if you fail the test, you have to wait a year to take it again, which is a horrible, horrible feeling. Mm-hmm. So I made sure that didn't happen. I passed all three, but I didn't take any chances because I didn't want to have to go through that. But it's worth it because you get to go to events, and it's kind of like a signaling thing because people to see the other CFA when they're looking for jobs for people to do investing work, they'll put in their search criteria CFA. It's kind of like a way to whittle down the available pool. But definitely, the contacts you make are pretty good, and they have good programs. So I'm glad I did it.
Mm-hmm. So when you were in college, you said you were a computer science major. was that kind of what you wanted to get into, was tech? And then how'd you find yourself getting an MBA and then getting into the investment side of things?
So I enjoyed the computer science. I did it more to help my dad because
Right.
also my roommate was doing it. But after working a little bit, I figured I had a good job at AT&T doing programming, and I figured after that I wanted to do more of the investing and finance. So I went and got the MBA at UT because I was working at Dallas at the time,
Right.
and so I decided to do that and try to get a finance job out of there. And that's how I got into AIG right out of MBA school,
Right.
right before the right before the crisis hit them.
Wow. Yeah. So, Doug, can you expand on that a little bit more? Working at AIG, right as the financial crisis coming on, right out of grad school. What's going through your mind? And um, just tell us what the feeling like at the company was. Could you see the collapse imminently coming before you, or was it more of a shock? Just tell us what was like being on the ground there.
Well, real estate wise in Miami, you could tell that it was a bubble and it was going to pop, but you could not tell AIG was going to be the pin that popped it.
Right.
First, let's talk about the real estate side of it. In Miami, they were it was a bubble, and it had been since Will Smith came out with his Miami song. And they were saying, oh, everyone, all these ex models were real estate agents now, and they're telling you better buy now because it's going to be as expensive as Manhattan. And there are these parties every time there was a new apartment building, with models and DJs and expensive drinks. And it was just a big party, and it was just unsustainable because Miami wasn't, the people that lived there couldn't afford to live there at that point.
Right.
It just wasn't sustainable. But at AIG, everything looked good there. Nobody knew that we had like this kind of finance derivative arm up in Greenwich, Connecticut, doing these credit default swaps with Goldman Sachs on AAA mortgage-backed securities that weren't really AAA. So we were thought things were fine, and all the people in Miami were buying stock on the way down, putting their 401k, including myself. It was my worst investment was AIG stock because it went to zero, because it went almost to zero. And I saw people in my office, when it hit, the news hit us like it hit you guys, like everybody else, because the insurance part of the business was 100% healthy. So I saw people lose their retirements, and they also had homes in Miami, so they lost some money there too. It was quite a dour mood there. With that, and also there was a lot of anger at AIG too, because as I think you guys remember, people were angry at them for popping the bubble and getting a bailout, and and so we had to take down not tell anyone we were working for AIG, and we took down anything that said AIG on it.
Like the Facebook employees these days.
Yeah, so I guess kind of after the crash in 2008, when you were working at AIG, so they just lay everyone off, and then you had to basically find another job, or was it not so instant?
It wasn't so instant, and they had some layoffs, but the insurance part of the business was still functioning pretty well, and had some hemorrhaging because of the economy, because some people were like, well, you guys will be able to pay the claims now, you have all these issues. And but I did not get laid off, and somehow I happened to survive there for another 6 years after that.
Wow.
They did bounce you around a bit because things were always the company never returned to its former glory. You know what AIG was? It was like the 800-pound gorilla of the insurance world. It was the first in 130 countries. It's like a storied company that was the first and started in China and was the first in all these places. And it was so huge, but then this really knocked it off its pedestal quite a bit. And the government came in and started meddling in things because they lent us a lot of money, so they had their say, and that kind of made things very uneven. And you had to change jobs a lot to survive, and things got shut down and reopened, and they went back and forth on things. So but it was interesting.
Right. Yeah, totally.
It's quite a thing to do.
Yeah, actually, I remember, I forgot when, but I was reading some report about how AIG, they received a government bailout, obviously, but they actually ended up paying the government back more money than they received. I'm not sure if that's correct or not. The government actually made a profit on the bailout on AIG.
It did.
I guess. I mean,
So
I might have to double check my sources there, but I think AIG, what they wanted 85 billion or something, and the government paid it back. I know for GM, the shareholders of GM got like wiped out, if I remember correctly, during the financial crisis, right? There was the government
That's correct.
went in, and the shareholders got wiped out, and they basically reissued new stock or something.
Yeah.
Okay. Yeah, maybe that happened with AIG too. I'm not exactly sure. I think Luke and I were a little young when that happened. It's really what, 12 years old or something like that, Luke, back in the day in the financial crisis.
yeah, I guess 13.
A little young.
But yeah, so I guess you worked at AIG then for 6 years. You ended up staying on after the bailout. And then what was your where'd you go after AIG then? Was that when you went down to Texas?
Yeah, I just went to Texas. So I went to Austin for grad school. Then I went to Miami for AIG, which actually ended up being 8 years. And then just some people from AIG went to a small global insurer that's based out of San Antonio and brought me with them.
Nice.
To do financial planning work and then also end up working on the investment portfolio of the company.
Right.
So just how it is in insurance. People move around quite a bit.
Yeah.
Staying 8 years at a company is quite a long time in insurance.
Right.
Okay.
So now that we got your background, which is pretty amazing to hear all the stuff you've been able to accomplish. What's your personal investment portfolio look like? Do you still do the 401k, IRA, and then you do like individual like OTC investments on the side? You do real estate. What's your investment strategy for your personal portfolio?
Well, my number one investment is real estate. So on the flip side of the Miami thing is it went from frothy and party-like to dead and dark. What I mean like that, like I was living downtown and all these new apartment buildings that once had the parties were all now dark and nobody's living in them. So people would buy 3 or 4 of these hoping to make a flip a profit on them, but ended up they got foreclosed on instead. And at that time I got married and my wife needed something to do. She was from another country. And so her credentials weren't passing over to the United States that easily. So she really is interested in homes. And then I was paying my rent one day and all of a sudden this person from Russia comes in and pays in cash. I was like, maybe it's time to buy a home. And so we bought a home in Miami and then, we fixed it up while we were living there. And then we decided that there was a foreclosure came up on the market near our house. We decided to bid on it and bought it and moved into that and fixed it up.
Nice.
And then bought another one. We moved to San Antonio. We rent them out. So that's like the biggest investment portfolio is real estate, and it's great for insurance. I mean, for the inflationary environment that we're in. So
right.
I know, Luke, you're buying a place too. I think that'll work out for you.
Yeah, it's kind of like a similar strategy to you. Like, buy your house, live in it, you can rent it out, and then get that down to 20% equity, refinance, and then move on, buy the next one, rent that out, and just kind of, rinse and repeat. I feel like it's kind of a fail-safe strategy, and then you can get some passive cash flow, and it's not a bad gig. So yeah, it seems to be working out well. How are those properties in Miami? Have they appreciated a lot since you bought them? I'm sure they've appreciated a ton.
Yeah, I mean, I bought one in 2012, the other one in 2014. And so, yeah, since then they've definitely gone up.
Nice.
And they pay rent too, and it covers the expenses. And, I think long-term are good. And it's nice to go back and see them now and then. And we bought a house in San Antonio too, a year after we moved here. And we have to move to a different district because my kid is going to be going to kindergarten soon. So we're going to move to a better public school. So we're going to rent an apartment in another place to see if we like the district. But in the meantime, we're going to rent out the house we live in now as like a short-term rental, like Airbnb, just to see how it works. Because my wife is like wants to try it out and all these things. So I'll see. We'll see how that goes.
Yeah, I know the Airbnb rentals are like getting insane numbers now because like if you're renting a house, and especially in San Antonio, like people travel to San Antonio, if you Airbnb, you can pretty much rent it out in a week, what you would get in a month. But I guess then you have to deal with the turnovers more often and dealing with people coming in and out. But yeah, you'll have to let me know how that goes. That's
Sure will.
exciting.
Yeah, we're
Um,
gonna work and more cost to it, but we'll
right.
see. We're not too far from the convention centers and stuff. We're close to downtown, so I think that helps.
Yeah.
It's funny, Doug, that you say you remember Miami being a ghost town. I just can't picture it now. Because I feel like
No,
it's
it's
so hot at the
crazy. I was living downtown. There's all these towers there, and they were all dark at night. You would see like a couple lights here and there.
Hmm.
Uh,
Yeah, it's funny.
You could park for free.
Wow.
holy
Yeah, Jimmy
cow.
and I were in Miami like, I don't know, 6 months ago or something, and it's just booming. But it's kind of like you said, I feel like everyone in Miami is like kind of living on credit. Like it's all this like flashy atmosphere, like everyone's got their, Rolexes on and their fancy cars. So definitely interesting. And I also thought it was interesting that like every single high rise in Miami is like condos and apartments. I feel like there's no like business buildings. It seems like to me that it's all just for apartments, but that could just be my brief perspective on Miami from being there for a short period of time.
Let me talk about that a second. So what Miami was at first was a place to park your capital from Latin America that you had gotten either ill-gotten through drugs or other things, and you park your money there in an apartment or something like that, or the governments flip a lot in Latin America. So maybe you had like a calm government, you made your money, then all of a sudden a very left-leaning dictator like Chavez takes power, and you get your money out. So you're gonna put it in Miami or Panama,
Mhm.
and that's how that happened. There was very few businesses there except for Carnival Cruise Lines, but now it's like a financial center now. Like downtown Miami has a lot of financial
Yeah.
companies like AIG and other groups, and a lot of hedge funds are moving there to get out of high tax areas like New Jersey or Connecticut.
Yeah, I mean everyone's moving to Florida in general just for the taxes. But I mean I saw like Kathy Woods is moving her hedge fund to like the Tampa Bay area. That's like
Yeah,
a major Wall Street firm that's moving to Florida. And like Elon Musk, Tesla's moving to Austin.
that's
So
right.
it's a crazy trend that we're witnessing. People are moving off the Northeast and the West Coast, all these different southern states. So
You stop moving here because they're
I
gonna
know. Well, hey, you own real estate there, so it's a win-win for you, I guess.
yeah, and that way, yeah.
Yeah,
That
Um,
way.
it's funny though, like we talk about Miami. I think one thing that Miami has going for it also is a lot of like crypto guys are going down there. So you always hear like the Bitcoin conventions happening in Miami, and all these crypto-based blockchain companies are based there. So Doug, being in insurance, I guess the whole point of insurance, right, is people collectively pool risk together. And the idea is this pooled risk pool allows for people to insure themselves against catastrophic events, right, where they can grab money from the pool that they contribute into to pay off any issues that may arise. In your industry, in insurance and just institutional investing, do you see application of blockchain technologies driving forward and advancing the way insurance is done, or some sort of like lending products that are created? Basically, do you see blockchain disrupting the type of business that you do?
I think so. I think a lot of ways it can. I think in two ways. I mean, there's definitely a lot of fintech companies that are trying to do that for insurance. Had a private equity arm that invests in these types of companies, the company I work for, and so it's definitely happening. I think insurance is a legal contract, right? And some of these blockchains you can code the legal contract on the blockchain, and maybe it emits the money immediately when something gets triggered, make your claim a lot faster. I think that's something that could happen.
right.
Mhm.
Uh,
And I
you
guess
know,
the blockchain, like a middleman's like less involved theoretically, right?
yeah, you can go more direct to consumer with it, basically. I don't know how. I definitely see that happening very soon with like personal insurances like auto and homeowners, and we'll see with bigger companies as well.
Yeah.
So
Um,
go ahead, Jimmy.
Well, I was gonna say, like, I remember when I was living in Atlanta, I got this insurance I got renter's insurance through this company called Lemonade, and they recently
yeah,
went public in like last year, and it was so easy to sign up, and it was like, you know, a great process. And I think Lemonade's trying to get into other types of insurance. I think we see Root now, which is an auto insurance company that's traded publicly as well. Um, so yeah, I think you're right. Like the personal insurance is kind of getting disrupted through these fintech startups. Um, So I'll be interested to see if it goes into like bigger types of insurance where there's a lot more red tape instead of, renters. I think I was paying like $7 a month. It was nothing. I think I had like,
Mm.
$5,000 in coverage. I had nothing in my apartment with my laptop and a TV and a couch. So it's pretty basic. But obviously, as you expand to other types of insurance, there's a lot more complexities that come with it.
Jimmy, you make a good point saying that, though. You said I only had a little bit of stuff and I didn't need much coverage. Before like technology and blockchain, that wouldn't be worth doing. It wouldn't be worth insuring that because the overhead and that would be too much. But now, like with blockchain and with the technology, that kind of insuring those things, the smaller things, is more attainable. More people will get insurance now, more protection, especially for people that they couldn't do it for before. But now somebody who may not have a lot, but it means everything to them, can now get it insured.
Wow.
Right.
That's interesting because I feel like that you say that, Doug, because I feel like with all these fintech startups, they always talk about democratizing finance, right? Giving financial tools and services to those who are less fortunate or who don't have access through the traditional means. And I never really thought too deeply about it, to be honest, because I always thought it was kind of like just a selling point that these companies would say. But you mentioning how Lemonade, like using the technology to give renters insurance, is actually what was considered like an undesirable type of thing to get into before. Actually makes a lot of sense to me. And I guess Robinhood, when they introduced commission-free trading, a lot more people got involved in the stock market and things like that. So interesting. Yeah, I never really thought too deeply about it, but I guess it actually is a thing that fintech is opening up.
Have you guys ever been to a country like Vietnam or India or maybe Mexico? You got
Mexico.
you don't have very many big corporations there, but you have but you have all these little businesses, that are, maybe, aren't big enough for a normal way to do insurance, but now these little businesses can be insured, like the shop on the corner or stuff like that, or the food truck that before couldn't be insured. Now they can be insured, and for things that they couldn't before, and that just makes a big difference to a family there.
Right. Yeah, I think this is like a perfect segue into Vamanti. We could have that conversation, but one question I wanted to ask first is I don't really understand the insurance industry too much, but so like your company does insurance and investment banking. So you take the pool of money that people put in to their insurance policy, and then you invest that money and try to grow that pool. Is that how it works, or is it kind of separate?
No, that's exactly what it is. We take
Okay.
the money that they paid us in premiums and we invest it in the meantime before we pay their claims. And that's exactly how Warren Buffett got rich. He's rich because he took this pool of money from Geico and a couple other insurers and reinsurance, and he took that money in between the time he had to pay claims and he invested it well.
Right.
And that's what all insurance companies try to do.
Yeah, it's funny to me because I always thought with insurance companies, I was like, how do they really make that much money if they're paying out all these claims? But I guess it's because they're investing the money, which makes perfect sense. But yeah, go
Every
ahead.
line of insurance is more profitable than others. Like some are profitable as the insurance itself, but some are not actually. Like auto is not really that profitable, but they make the money on the float, on the float, the money they have in the meantime, making the income off it. So I'm going to say, let's say, have 5 years before they take the premium, pay the claim, make 5 years of interest. That could be, 30%.
Mm-hmm. And then I guess a lot of that side of the business is just managing the risk of that. Is like how risky are your investments if you have to pay out a certain amount over time, and just kind of making sure that you're in safe enough investments.
Well, that's exactly right. And when the regulators actually look at that, they audit our investments, and also credit rating agencies like S&P look at that too to see how strong is your balance sheet, what kind of storm can you weather.
Mm-hmm.
And so a lot of my job is dealing with that and dealing with those questions. And look, I'll give you an example with us. We have actuaries that take the insurance lines that we have and they project how much we're going to pay in claims in the near term and over time. And based on that projection, they look at when we're going to need the money. So we buy bonds based on, okay, they think it's going to over 5 years, we're going to pay these claims. And also they put up reserves for these claims they think they're going to pay or they know we're going to pay. And under those reserves, we have to back them with investments that are certain liquidity and certain strength, right? Mm-hmm. Corporate bonds, maybe. And with the money excess over our reserves, which is our equity, we can put in more risky things like equities or hedge funds or loan it ourselves directly to other companies. But yeah, that's how it works.
Interesting.
So, Doug, in this zero rate environment, are the pools, are like the investments that you and other insurance companies taking on, are they more equity based, just due to the fact that they need to find a return and it seems difficult in everywhere besides equities?
So we still have to back the reserves with fixed income because that's what the regulators require. But with money that's excess, we've definitely been more risky. So when I first started in the insurance industry, you could put it in like a treasury and still make a good 7-8% return. Now that's closer to zero. So companies in all, institutional investors like us and pension funds and endowments are now putting in equities and private equities and even blockchain. Cryptos. To get a little to make up for that loss in coupon income that we were used to get from bonds, which that's one reason I guess the Fed can't let the bubble pop, because all these pension funds and insurance companies will lose a lot of money.
Right. So in a way, I guess 2008. I guess that's when quantitative easing really became a huge thing, and it only accelerated with the coronavirus. Do you see a world where the Fed actually kind of does taper eventually and sort of stops all the buying that it's doing, or is it kind of in a state where, like you said before, if it stops, then the music stops playing and everyone's got to look for a seat and someone's going to be left holding the bag?
Well, I do see a world where I think they're going to try this year, actually. Powell's been saying so. And I have a little conspiracy theory that says that the reason that they were outing Fed members for not insider trade, but trading ahead of the buying of the Fed and getting in trouble for it is to oust them so they can put members that are more dovish and won't taper. So I think they will try to taper. And I think they'll find very shortly that the market will not like that, and the pain will be so great that they'll untaper. And there is a time in history where we did taper, and we didn't have quantitative easing. But in the 70s, we had very easy policy then as well, and we had inflation. And to finally get rid of the inflation, Paul Volcker, who was the Fed chair at the time, raised interest rates like 18%. Can you imagine what happened? We had 18% interest rate. Well, people were like calling for his head. Yeah. I can't believe he pulled it off, and he did it. But I don't know that the people would be I think it'd be even more painful now because how leveraged we are and how long we've had 0% rates. And just think about it. The government has what, 30 trillion in debt right now and climbing. 18% on 10% on that would be $3 billion a year. Well, they only take in $3 billion a year in receipts. So I don't know how that would work. So I don't know where they'd go with this. It's like we're hooked on a drug and
we can't stop.
Yeah, and I guess the one benefit, right, is it seems like there's no returns anywhere. Go to Europe, go to other parts of the world. It seems like all central banks sort of have super low rates. Other than I think countries in Latin America actually have decent rates. I think Brazil's central bank has a rate over 4% at this point. But in the Western world, you can't really find anywhere with positive rates. I think even parts of Europe, they have negative rates, which I couldn't fathom. You're getting punished by saving money. It just makes no sense.
They do. Actually, they pay you on your mortgage in a few countries.
That's fantastic. That's
Denmark. But no one can afford to live there. No one can afford to live there now because the real estate, these places are crazy. In the Nordic countries, the real estate is obscene. If you own real estate, you're great. But if you want to buy,
not good, yeah.
Good luck. But even in Latin America, the interest rates are low compared to what they in history. Brazil got down to 3.5%, and because of inflation, they've actually been tightening and ramping it back up, and you can see that the pain is definitely there, but they have to.
Right.
It's tough.
Yeah, so I guess now's a good time to pivot in kind of the OTC markets. Do you with your personal trading account, do you trade a lot of OTC, or is it more just you'll find a ticker every once in a while and then invest?
The latter is opportunistic. When something comes along that I think is really, really interesting, I will invest in the OTC, but it's not my bread and butter.
Right. And then how did you find Vamanti? Was that just kind of on Twitter, you saw it, did some research on it, or did you like the story? How did that go? And when did you start investing in Vamanti?
That's exactly what happened. I was following a guy I thought was interesting, Neil Stockhacker and Rich X Million, were two people I had was following on Twitter. And following Twitter is fun because you can get a lot of information in very short bursts, which is good when you're have long hours at work and you have kids. It's a great way to go. So they had pointed out some other things earlier that I thought was interesting, and so when he talked about Vamanti and his company in Vietnam, which interests me because I like emerging markets, because I've always been interested in emerging markets because that was my job. AIG was working in emerging markets with investments in emerging market and also underwriting insurance in emerging markets. So Vamanti really stuck out to me because of its Vietnam and the payment. I know border transactions are very expensive, so it seemed like they're going to answer that as well. I know they're going to offer a yield on the stable coin, and I know the yield is very in short supply. So I said, well, if they can solve these problems, people are going to want it.
Yeah.
So that was like a year and a half ago. So it's been an interesting journey.
Yeah, it'll be interesting to see where it ends up going. And early in the conversation, you're talking about how businesses in Vietnam, India, and Mexico, how there's just a bunch of small companies that they don't really have these major corporations, and I guess these entities don't have access to traditional banking services or other types of financial services that we take for granted here in the U.S. And that's what I found so appealing about Vamanti, because I really don't know much about emerging markets, to be honest. I just know two things. One, if you want to grow an economy, you need strong financial services. And the second thing I knew was Southeast Asia is blowing up. And what attracted me originally was the fact that people were sort of turning away from China with their manufacturing and their supply chain concentration there and expanding it to Vietnam. So I figured that country was bound to grow. And it seems like, as we go throughout time, the GDP there is, I think it's over 5% growth on an annual basis. And it only seems like it's going to continue going forward.
Yeah, lots of tailwinds for Vietnam and Vamanti. And they have good demographics too. A lot of countries now aren't even replacing themselves, but Vietnam still is. And yes, companies from China are moving operations to Vietnam.
Yeah.
And the rest of Southeast Asia.
Mm-hmm. So one thing I thought was interesting that you mentioned before is the institutional investors looking for returns and yields in non-traditional means. Like you said, they're getting more into equities and even into cryptocurrencies. So with a cryptocurrency, particularly a stablecoin that is designed to generate a yield through loans to SMEs in a developing economy like Vietnam, do you see a massive hurdle for institutions like the one you work for getting involved and staking a coin like this to create yields?
Oh, one other thing I want to mention about Vamanti, I really like the founder's story too, because he was a refugee from Vietnam. I think people with that background are excellent founders. Okay, back to your question. Yes, there is a hurdle for institutions like insurance companies and endowments and pension funds, is that we're regulated. And those regulators say you need XYZ kind of investments to back your reserves or whatever. And they may say the stable coin doesn't count, and you have to put in your risk portfolio or can't buy it at all. So you have a regulatory hurdle there that they may not see it as a sound enough investment for an insurance company. So we'll have to see how we deal with that. But dealing with regulatory agencies is a job in itself.
Yeah, no, totally. Another thing that attracted me to Vamanti so much is, or just like builds up my conviction in the play, I should say, is I love Kevin O'Leary.
Yeah.
And he always talks about how he is in a constant search for yield as well. And what he has been putting into is USD coin, which is operated by Circle. And his excess cash he's putting in there, and he's getting like a 4% return, which is, I guess, good in these days, right?
It is.
But he's also concerned about the regulatory environment, and he is taking on Circle as being one of the winners of the stablecoin market as time goes on, and the unregulated coins start to die, and new regulations from regulators emerge. So I think once more people get exposed to what USDV is, I think there will be a very, very nice turn of events, and I think the stock will do very well. But until then, it seems like Circle is sort of leading the way in this regard.
Yeah, I think going off of that, Jimmy, Kevin O'Leary, I watched his interview they did recently. He was basically, so he's like a kind of a known crypto investor, but he only owns Bitcoin and Ethereum, and all of his other investments are stablecoins. So there's a lot of speculation with Vamanti and stablecoins in general that it's going to be a, multi-billion dollar market. And I feel like USDV is like ahead of the curve. And we keep saying this with like regulation and everything, but USDV has everything these other companies don't. The only thing that it doesn't have is the marketing and the funding to back it. So talking to someone who's kind of in the institutional area, how hard is it to get like, say like $10 million or something from an institutional investor, because it's such a small part of their portfolio, like you were saying, because that has to be like a high risk section. Like how many people are actually willing to take that risk? I imagine it's not very many, right?
Well, I would say it's harder from an institutional like an insurance company or a bank or those kind of things that are regulated. But I think there's lots of places, there's lots of kind of groups that would do it more likely than an insurance company would, who's more conservative. You have angel investors, you have venture capital funds. The money is, I think there's a lot of people that would do it that have the ability and are not as regulated as insurance companies that would definitely be able to stake that and put in there. It's just a matter of connecting them.
Right.
I mean, the money sloshing around like Silicon Valley is immense.
Mm-hmm.
So I think there's definitely pools out there.
Yep. Just gotta find the right investors.
Family offices could do it.
Yeah.
There's a lot of stuff.
Yeah, I saw somewhere actually. I think I saw on Twitter. So Kobe Bryant, before he passed away, he bought a 10% stake in the company Body Armor. I think he paid $6.5 million or something like that now. And Body Armor was just bought out by Coca-Cola, and I think his family's receiving a payment of $400 million after only a few years. It might even be $800 million, I forget. But it's regardless, it's an insane amount of return over a short period of time. And one thing I always tell Luke, and I talk about with my guests, is there are so many outsized returns if you invest in companies early that the general public doesn't have access to, because usually it's through venture firms or you have to be an accredited investor, things like that. Because I guess the regulators are trying to protect the little guy, which makes sense. But in reality, getting in on a company on the ground floor like Body Armor that Kobe did yielded returns that aren't fathomable. You hear about these guys who invested in Coinbase 5 years ago who made over 10,000% in a very short amount of time. But anyway, what I always imagined, or my hope for the OTC, has been you have companies go to the OTC instead of these venture companies, and that's where they raise capital, and that's where they get an investor base. And as they grow up, they graduate onto more stringent national exchanges like New York Stock Exchange or NASDAQ. And that's where the initial shareholders can yield a massive return, where you don't have to be an accredited investor, or you don't have to be someone in the know to get in on this company early. And that's another reason why I like Vamanti, because I do think it's reaching this next level of potential return for an investor, and it's reachable. It's not you have to know some guy who knows some guy to connect you, and they don't want your money or whatever. It's already on an exchange where you can just buy it. So I hope the OTC turns like that for more and more companies instead of just being known for scams. But
yeah,
I hope you're right too. Because actually, you guys might remember the late 90s were like very go-go, and the tech stocks and all these companies were IPOing, and they were IPOing earlier in their life. Like Amazon was very early in its life and it IPO'd. So you could get in early on that stuff. But now I think partly because of the 0% interest rates and all the money flooded the market, companies now IPO so much later in their lifestyle that you're IPOing when they're already like 55 billion, like Rivian, which is not like it used to be. And so it is very hard for the average investor to get early on a company now when the IPO so late. It's not like an IPO is like a cashing out event, not like an event to raise money, because it's so easy to raise money from VCs now because there's so much flooding of cash. So I really hope that's true, because I think investors don't enjoy like that, like they did in the late 90s, where you could get in early on a company. It just doesn't happen anymore.
Mm-hmm.
Interesting. I didn't realize that was a thing in the 90s. It's good to know, actually, because Yeah, I feel like you're 100% right. Like, I think, yeah, Airbnb or Coinbase IPO'd at a valuation of 100 billion. It's like, all right, it's already 100 billion. Like, it's
Yeah,
hard to get a return there.
you missed the life-changing gains, you know.
Mm-hmm.
Somebody bought in when it was like 25 cents.
Yeah, I think there was some story with Coinbase. There was some guy who worked at Coinbase, and he was like, he had so many shares before they IPO'd, and he kept like saving them up and saving them up. And then Coinbase, when they finally IPO'd, he ended up being worth like, I don't know how many millions and millions of dollars, and he just quit, retired, sold his shares, and lived happily ever after. So it's like, unless you're working for these companies, it's very hard to get in early. And I feel like the OTC, like Jimmy was saying, it's like one of the only ways that the retail investors can get in early. But they have the reputation of being a scam and everything, and people don't want to invest, and then people make one bad buy and they don't want to keep investing. So it's definitely a slippery slope. But I think if you really put in the research, you can find the good ones. So hopefully,
Another thing,
I was saying hopefully VMNT is going to be one of those. But
I think so. Another thing that's happening too is I think the tokenization of assets too, I think will broaden the reach beyond just institutional investors and accredited ones, which is a very small pool, really. The tokenization, I think companies are putting themselves on the Merge exchange, on T0, instead of being public, instead of OTC. I think there's some companies are starting to do that, and also, like maybe buy a piece of art that's worth 10 million bucks. Well, most people can't buy a $10 million piece of art, but they can tokenize it, and you can buy a piece of that art or a piece of a commercial building that, if it's a good building, I think that'll spread the wealth out around quite a bit if you put your mind to it.
yeah.
Yeah. And one thing I always thought was crazy is just, we live in 2021. How is it that a transaction doesn't settle immediately? How does it still take 3 to 5 days? And I guess blockchain is hoping to solve the settlement process. But anyway, Doug, Luke and I really thank you for giving us all this time to talk with us on this Tuesday evening. I know you're still at the office. You probably want to head back home and see your family or anything like that. But really, it was awesome talking to you, talking about the institutional landscape, talk about your background, talk a little bit about real estate, talk a little bit about crypto. It's just been an awesome experience, and we've known each other for a while now. I feel like it's nice to finally see you in person, talk to you.
So it feels like I know you guys well, even though we've never actually met in person. But,
Yeah, and we appreciate you always commenting on the show and watching and providing input, because there's not many people who do. So really appreciate that, and obviously thanks so much for coming on the show.
The one thing about the show, I think it's great you guys are doing it. I know somebody else started a podcast like 10 years ago, and even if you never make money on it, what he gained in contacts from doing it is immense. He started a wealth business, and people felt like they knew him just from listening to the show for 10 years. They immediately signed up for the business. And he's an amazing investor just because of what the ideas he gets on the show. So I think the benefits you guys will realize is it's hard to do it, consistently, but that's the hard part, be persistent. And,
Yeah.
And you're missing a key thing. You need to use that rap that I made for you guys.
Oh, for the intro video? Doug, we're having a problem with the copyright. YouTube is so strict with that stuff. It's like, but maybe if we make a little mix, it won't catch it. So.
Oh yeah, instead of smack that, slap that.
Slap that,
yeah. We gotta use that, and we gotta make like a funny music video to go along with it for sure. But a great idea, Doug. And again, thank you for your support, and have a great evening. And talk to you
guys.
Thanks so much, Doug. Take care.
Later.